Alright, good morning everybody, my name is Cole Berner.
Ms. Caitlin Bushnell.
So we're going to be covering the financials and real estate sectors. I'll start off with financials, Caitlin will cover the real estate afterwards. So the financial sector is a major portion of the S&P 500 and constitutes 13.4% overall, and it's 8.7% of the SIP portfolio. Over the last 5 years, it's pretty much stayed in line with S&P 500. Just outperformed it by 0.09%, so they're very similar. And some of the industries that are in the financial sector are banks, nursing mortgage finances, investment banks, and insurance companies. So this is just the S&P 500 comparison. Like I said, very similar. Stays right in line. All the jumps are pretty much the exact same. So it's a highly cyclical industry that's really related to the overall market conditions. So these are some of the key players in the banking industry. These are the 5 largest banks in the United States. JP Morgan Chase, Bank of America, Wells Fargo, Citibank, and the US Bank. So like I said, highly cyclical industry. They make their profits off of charging interest from consumers. I'm going to mainly focus on the retail sector of banking, the consumer-facing part. In this industry compared to like an investment bank or something like that. So when business loans and consumers are, when the economy is doing well, more people take out loans, build stuff, start businesses, they make more profit that way. Some of the key ratios for banks to pay attention to when we're evaluating them, the loan to deposit ratio, the Tier 1 capital ratio, which takes into account core equity capital, which is common and preferred stock, other accumulated income and retained earnings, and that's divided by risk-weighted assets. So, for example, cash would be rated at 0% because there's no risk, and then other assets are given a percentage based on their risk level. So that's a really important ratio to determine how risky a bank's holdings are. And another important ratio is non-performing loans ratio, which non-performing loans are basically defaults and people aren't paying their loans back. So it's bad debts, and it's calculated after a borrower hasn't paid them back in a certain number of days. That can be set at anything from 60 days, 180 days, whatever the bank sets it at. That's just divided by total loans. It should be under 1%, would be a good goal. It shouldn't be a high ratio at all. Alright, PESTEL analysis for the banks. I think these 3 are the most important for them: economic, legal, and technological. So some economic trends that are happening right now. Interest rates, just announced a week ago, are holding steady for now, and that of course caused a rally in the stock market. That was kind of surprising. So the benchmark right now that the Fed is saying is 2.25% to 2.5% overall, and so for the foreseeable future they're going to hold steady and probably increase at some point later. There's also a lot of global uncertainty right now that is part of the reason why they held interest rates steady. That includes our trade war with China right now and the issues with Brexit. And then on the legal side, the current presidential administration has decreased a lot of the regulation in the banking industry, which is improving profits for them, and then changes to the Dodd-Frank Act. So that happened right after the financial crisis in 2008, and basically one of the major portions of it was defining SIFI, so they're systematically important.
SIFIs.
Cities.
Sorry.
Systematically important financial institutions, so basically they're too big to fail. The threshold for that used to be 50 billion, and it was increased to 250 billion, so that took a lot of regulation off of a lot of those banks that were in that range. And one of the major parts of that was being able to merge with other banks. Technological trends right now are very important. There's an increased focus on technology and digital innovation, including security. So IT and cybersecurity is extremely important in the banking industry. We see all the time there's data breaches from major companies. So from a bank, they're holding people's most important assets and all their money, and it's extremely important that they invest heavily into IT and cybersecurity. And then another thing that's happening right now is a lot of banks are offering online-only savings accounts, and they're offering very high interest rates. So, for example, like Discover has a new online banking-only savings account that offers 2%, which is much higher than other banks, and they're basically cutting out those overhead costs of operating branches. Some key economic indicators, of course, just when the economy is going well, banks are doing better, so GDP, housing development, and monetary policy, so interest rates are all very important. Basically, any positive indicator of the economy is going to be great for banks. Quarters 5 forces, rivalry among existing competitors is high. There's a few major players at the top, and they're competing with each other. It's a very similar industry where they can't differentiate their services that much. In the retail banking side, they all have basically the same business model. So that makes for fierce competition. The threat of new entrants is medium. There's pretty high barriers to entry for new banks to start up, including infrastructure, cybersecurity, and regulations. And then the bargaining power of buyers and suppliers is both low. They're pretty much the same thing, so your suppliers are the depositors, and then buyers are people taking out loans. So they're the same individuals, and generally individual consumers don't have that much power over the largest banks in the country. Threat of substitute products or services is low. Not many other places to go than a bank if you want to invest your money. And then finally, this is just some breaking news that came out today. I think this is what Kim was referencing earlier. So SunTrust Bank, which is in our SIF portfolio, was acquired by BB&T Bank. So they are both southern banks. BB&T is located in North Carolina, and SunTrust is located in Georgia. They're regional banks. And this creates the 6th largest bank in the United States, actually. So it's the largest bank merger since the financial crisis. And they cited technology as one of the major reasons that they merged, because they would be able to better compete with the largest banks that I listed earlier.
So you guys are going to have a special assignment aside from this, because so they announced the deal. It's a stock deal, so essentially we own SunTrust. We'll get shares in BB&T. So I'm going to leave it up to you guys to do a little analysis on BB&T and decide if we want to cash out now, because SunTrust stock kind of popped, which is not uncommon after an announcement of this kind, or if we want to stick it out, go through the whole regulatory approval process, which likely will take about a calendar year, and get stocks in BB&T at the end of the day. So I'll remind you that later, but that'll be a special assignment for you guys since it happened in your sector.
Yeah, so the stock price jumped from I think 58 to 65 real quickly, and then went down a couple dollars after that. And with that, I'll hand it off to Caitlin to cover the real estate sector. Do you want to come over here?
Yeah, so this is the real estate sector, which is actually in our portfolio. The SIF portfolio, not necessarily the REITs one. So this sector constitutes 3% of the S&P 500, and over the past 5 years has outperformed it by 0%, which means that it hasn't like lost anything, but it hasn't gained anything, so it's fine, I guess. And we have two companies, which are both REITs, that are in the portfolio, and we have 1.2%. So the two industries are the REITs, the real equity real estate investment trust, and then the real estate management and development. So these are like brokerage companies that haven't classified themselves with the REITs classification. So just to have a little comparison as well, the dark red at the bottom, this is the real estate, and then contrasted with the other red, the S&P 500. And we can see it's very stable, very flat line. But at the same time, it does move a little bit in opposite to the S&P 500, especially like around here, number 1. So some of the notable real estate companies are the American Tower and Simon Property and Crown Castle that Ben had mentioned, and then some of the non-REIT companies are the Jones, Lang, LaSalle, and Kennedy Wilson. So this industry is relatively defensive. That's linked to the overall market conditions. It has a stable risk and reward compared to other sectors. This is why we had the 0% outperformance. The ones, and then they're more defensive even than the non-REITs because of the 90% requirement. And then even though they're defensive, the production does pick up during the early stages of the economic cycle. So some of the special metrics that's used for real estate refers to or more like if real estate, if like individual or company is going to look at the real estate for itself, is to look at the price of comparable properties, because establishing a benchmark in this sector is very difficult because each property has many different variables that goes into the price. Another thing people look at is look at the year-to-year variance on the sold average dollar per square foot. So just look at how much the price per square foot changes in whatever project you're working on. And then the funds from operations, just to see how much money that comes from the investment, and then the capitalization rate, because the annual income and like the operating costs, they change variables, so this is a way to see the efficiency. So some of the key economic indicators that go into real estate is, first you have to look at the population trends, the immigration going into a place or going out of a place is important to know where the people are gonna be. And then once people go to a place or leave a place, that influences the employment statistics, or the employment or the unemployment and the wages, just to see how much money people have. And then that goes into building housing, building schools, building a lot of the other real estate things. And then to be able to build them, you need the interest rates and the mortgages. So these are all things that you could look at throughout the whole process of building real estate. The key drivers of profitability in real estate is, number one, the equity growth from appreciation. This is going to show you the long term, when you have a long term, to let you know how much money you're gonna have if you just leave it in there. And then the number two is equity growth from cash flow. So this is the, you have the, like rents or dividends or just money that's coming in a more short period of time.
What do you mean by equity growth?
This, like how much the money that you put in and the stock, whatever, is going to appreciate the value of what you bought,
Okay.
how that's going to appreciate over time.
Okay, so you're separating out appreciation of the actual assets from cash flow. Okay.
Because you buy some building or buy a company with the building, that building's gonna appreciate in value.
So especially when you're looking at commercial real estate, the number one way to value a piece of property, well, there's two ways. Relative valuation, similar to like what we do with stocks, picking comps and looking at that value. And the other one is you make a value based on the income that building's able to generate, which essentially means if the building has appreciated, that's because the cash flow it's able to generate has grown. So those two things should be linked.
Yeah, okay. I think the second one, was more like for the rent or whatever, the dividend.
Yeah, so the idea is this, like, if rents go up in the building, that's increases the cash flow of the building, and basically, you look at the value of the building just as like a summation of all the future possible cash flow that the building can generate, right? So if the building has appreciated, that's because future cash flows have also gone up, or predicted cash flows have gone up. Does that
Yeah.
make sense? And so you can see where those two things are linked?
Yeah, I see how
Okay.
they're linked, but I think with depreciation, if we're gonna sell it at the end, that would be the difference between when we bought it and when we sold it. Or are those lit?
So there's certainly a difference between appreciation and cash flow, but if you're talking about equity growth, as in the growth and value of of your ownership stake in an asset, whether that's coming from appreciation or cash flow, that equity growth is gonna be the same thing. I think that's where I'm taking
I see.
issue, not the difference between appreciation and cash flow.
Okay, I see. And then some of using the pestle analysis, some of the emerging trends that I identified, the first one is economic. So right now, the macro policy is relatively reserved because everybody is anticipating the economic downturn. And then the low interest rates, which make these projects easier to carry out and to start. And then technological, as Cole had mentioned earlier, the explosion in online stuff, like, has really began to replace the brick and mortar buildings. You don't need to go to a bank anymore. You don't need to go to a grocery store anymore. You don't need to go to, movie theater anymore because you do all of that at home over the internet. So that's really gonna change, like, the real estate outlook as well, because we don't need physical places to carry out our lives. And then also ecological trends, the climate change is create the mass migrations and population displacements. For example, everybody moving out of South America because of the droughts, the communities in Alaska that are disappearing, and all of the fires in California, the lower 48 places are going to become inhabitable, and people are going to move, and at the same time, it's another layer of risk for these real estate companies to build things in different places. And then the competition in the industry, the real estate, it's moderate. I think there are those large companies at the very top that are able to create or capitalize a lot on the market and build big projects. At the same time, there's not very many people that can come in to it at a high level. And then the buyers' bargaining power is relatively low. The suppliers is gonna be higher because of the land. The land is what has the value, and they have to be able to dictate the price on that. And then the substitute, threat of substitute is medium because we still right now need the buildings to be built, but not sure too much in the future with the trends that are going on. So that's all we have. Does anybody have a question?
I would say for the banking side, you might want to give some thought to substitutes, because while I'm not planning on getting rid of my bank account anytime soon, there are now a variety of online platforms, whether it's direct lending, like groups of individuals lending directly to a business or a person, and a bunch of different competing kind of fintech products that those companies are oftentimes private, or if they are public, they'll be classed as technology companies, but they might be influencing the way people bank quite a bit. So I'd consider the influence of substitutes is my advice there.
Yeah.
Questions from the class? I'll make one comment. I really liked that you guys didn't do a full pestle and only picked the parts that you thought were most relevant. So I'd mentioned that the other day. So a little bit of a ding on the guys who did walk through every element of a pestle. Make sure we have time limits in this class, so make sure you're giving me the most relevant information. So I want you to be complete and thorough and do these things, but do a full pestle analysis, but then say, maybe this piece I don't need to talk about in class, okay? Use our time valuably. Thank you, guys.